Ever heard of a company that cooked its books so badly it nearly broke the entire stock market? A company that grew from a tiny long-distance reseller into a global behemoth, only to collapse in one of the most spectacular frauds in history? This is the story of WorldCom, a tale of ambition, deception, and a lie that reached a staggering $11 billion. Imagine it's the late 1990s, the height of the dot-com boom. Telecom is king, and WorldCom is the crown prince. They're buying up companies left and right, including MCI, a giant in its own right. Their stock is soaring, and everyone, from Wall Street analysts to everyday investors, believes they have the Midas touch. By 2001, they were the second largest long-distance phone company in the United States, a true titan of the industry. But behind this dazzling facade of success, a dark secret was festering, a fraud so massive it would make history. At the center of this web was the CEO, Bernie Ebbers. Picture a former milkman and motel owner, a charismatic leader known for his cowboy boots and aggressive business style. He was the face of WorldCom, lauded as a visionary who could do no wrong. He built the company through more than 60 acquisitions, creating a sprawling empire. But Ebbers had a problem. He had borrowed heavily against his own WorldCom stock to fund his other business ventures. As the dot-com bubble began to burst and the stock price started to fall, he faced margin calls that threatened his personal financial ruin. Desperate to keep the stock price artificially high, the pressure on his team to hit the numbers became immense, setting the stage for an unprecedented level of creative accounting. So how do you hide billions of dollars in losses? The mechanism was deceptively simple, yet brilliantly fraudulent. It centered on a basic accounting principle. The company had massive operating expenses, specifically line costs. These were fees WorldCom paid to other telecom companies to use their networks. Standard accounting requires these to be listed as expenses, which reduces your reported profit. But under pressure from the top, WorldCom's finance department, led by CFO Scott Sullivan, started doing something extraordinary. They began categorizing these billions in everyday expenses as capital expenditures. Think of it this way. It's like treating your monthly grocery bill not as a cost, but as an investment in a new house. By capitalizing these expenses, they could spread the cost out over many years instead of deducting it all at once. This single move magically transformed massive quarterly losses into impressive profits on paper. The numbers looked great, Wall Street was happy, and the stock price held steady. They also created bogus revenue entries out of thin air, literally inventing income to further inflate their results. It was a house of cards, built on a foundation of pure fiction. But you can't keep a secret that big forever. The hero of this story is a woman named Cynthia Cooper. She was an internal auditor at WorldCom, a vice president who was known for her diligence and integrity. In 2002, a senior manager in the finance department quietly came to her with concerns about a strange $400 million accounting entry he couldn't explain. He felt something was deeply wrong. Trusting her gut, Cooper and her small team decided to investigate. They started digging, often working late at night, in secret to avoid suspicion. They knew they were challenging the highest levels of the company, including the celebrated CFO, Scott Sullivan. The pressure was intense. They were told to back off, that they were looking in the wrong places. But they persisted. Poring over financial records, they uncovered the scheme, the billions in operating costs that had been improperly disguised as capital investments. When they finally pieced it all together, the number was breathtaking. $3.8 billion in fraud. And that was just the beginning. Realizing the scale of what they'd found, Cynthia Cooper made the courageous decision to go to the board's audit committee, effectively blowing the whistle on her own company. You might be asking, where were the regulators? Where was the watchdog? At the time, WorldCom's external auditor was Arthur Andersen, one of the Big Five accounting firms. They were supposed to be the independent check on the company's books. But Arthur Andersen was already embroiled in another massive scandal, Enron. They were facing intense scrutiny and, frankly, failed to catch WorldCom's blatant fraud. They approved the company's financial statements, giving them a clean bill of health year after year. This colossal failure exposed a deep flaw in the system. The very firm paid to ensure accuracy was either incompetent or complicit, and it highlighted the cozy, and sometimes corrupt, relationship that could exist between a company and its auditor. This failure was a wake-up call, showing that even the most trusted names in finance could not be relied upon to protect the public. In June 2002, the truth finally came out. WorldCom admitted to the fraud, and the fallout was immediate and catastrophic. The company filed for what was then the largest bankruptcy in U.S. history. The stock, once a darling of Wall Street, became worthless overnight. Over 20,000 employees lost their jobs, and investors, including countless regular people who had bet their retirement savings on the company, lost everything. A total of $180 billion in shareholder value evaporated. Bernie Ebbers was sentenced to 25 years in federal prison for his role in the fraud. CFO Scott Sullivan, who cooperated with prosecutors, received a 5-year sentence. The ultimate lesson from the WorldCom disaster is a powerful and timeless one. Integrity is non-negotiable. The relentless pressure to meet short-term targets at any cost can lead to catastrophic failure. It also led to landmark legislation, the Sarbanes-Oxley Act of 2002, which completely overhauled corporate governance and financial reporting, holding executives personally accountable for the accuracy of their company's financial statements. The story of WorldCom serves as a stark reminder that no company is too big to fail, and that the truth, no matter how deeply buried, eventually comes to light. It's a testament to the courage of whistleblowers like Cynthia Cooper and a cautionary tale about what happens when greed and ambition go unchecked. Thank you so much for watching. If you found this story as fascinating as I did, please hit that like button, subscribe to the channel for more deep dives into history's biggest events, and ring that notification bell. We'll see you in the next video.